Hi everyone, welcome to another weekly Forex forecast. My name is Justin Bennett with Daily Price Action, and in today's forecast, we're going to talk about the EURUSD, the pound versus the USD, the dollar versus the Japanese yen, as well as the Australian dollar versus the USD, and we're going to wrap things up with gold or XAUUSD. I'm going to show you all the key support and resistance levels I'm watching, as well as some key levels that could trigger breakouts for some of these markets. So let's get started right now. A quick disclaimer that today's video is for educational purposes only. All views are my opinion and are not intended as investment advice. Forex is a high reward, high risk business, and you should not trade with borrowed money or money you cannot afford to lose. See the description of this video for the full disclaimer. Before we get started, be sure to hit that subscribe button below and also click the bell icon so you get notified every time I post these videos. So first up, as always, we have the EURUSD. Now, this market has been consolidating for quite some time, and we saw that continue last week. So notice how choppy this pair has been for several months. In fact, if we go back almost 2 years, the same thing has happened. So the euro has been a difficult currency pair to trade, and that didn't change last week given this spike up here into resistance. Now, this 111.70/80 area is something we've been talking about now for quite some time as one that could attract sellers. So notice how we got that spike into this area, and then we had this long upper wick that formed on Friday. That wick does, of course, signal an increase in selling pressure up around that area. So we could see a rotation lower this week, perhaps back into that 110.70 support area. However, as I wrote on Friday, I do think that the bigger opportunity here could come following a close below this channel bottom. Notice we have this ascending channel that's been intact now for quite some time. So a close below this area could trigger a larger reversal, perhaps down to 109.90 or even the 2019 lows. However, if we see another push higher up into this region and we do see a break there, this channel top that dates back to 2018 could signal a turn higher for the euro in 2020. So really, it comes down to whether or not the pair is going to break this key level up here or this support area down here. So really, it's going to come down to whether or not the euro breaks higher or lower from this consolidation zone. So right now, I think the euro is going to continue to be difficult to trade simply because we have a lot of this choppy price action and indecision, especially as long as the euro is caught in this sideways range. So while you could try to trade this range between that 111.70/80 resistance area and 110.70 support, I do think that the better opportunity in 2020 could come if the pair can close above this area or below this one. So that's what I'm waiting for. And for the swing trader, if you're trading on the daily time frames, sure, you could try to trade this range between here, but you may not want to hold for more than a day or two simply because of the choppy price action we've seen. So in order to gain momentum here, I do think we need to see the euro either break higher or lower from this consolidation zone. Next up, we have the British pound versus the US dollar. And this thing has played out perfectly given this consolidation that we saw earlier this year. So I talked about this area several times between 127.70 support and this 129.80 resistance area. So this consolidation that formed did so after this 800 pip rally back here. Furthermore, we've had these higher lows and also higher highs since earlier this year. So this does signal a short-term uptrend that we wanted to play off of. Now, I talked about the British pound back here as it was closing above this range. And when it did, I said that a close above this 129.80 area could trigger a move up into 131.70 with a break there, taking the pair all the way to 133.40. So notice where Friday closed last week. Yes, it did spike above that 133.40 area, but it did close the week right below it. So I do think that 133.40 is still serving as resistance this week, which means we could see weakness, perhaps even all the way back down here to 131.70. However, that said, you have to keep in mind that this uptrend is still intact. So yes, the British pound has been under pressure for years, However, this short-term uptrend is still intact in that we have higher lows and we also have higher highs. So as long as that's the case, I think you have to be really careful trying to sell the British pound. Now, notice too how this 133.40 area has served as a range top for the pair for quite some time. So if the British pound is going to break higher, I do think we need to see a close well above this range top up here. So until that happens, the British pound could stay under some pressure this week and again rotate lower, perhaps all the way back into 131.70. Either way, I'd be careful trying to sell or buy the British pound simply because of the volatility we've seen here. Friday's candle alone moved over 300 pips. So if you're not careful here and you size in too much, you could get burned here. So that's why I think that the best thing to do is either avoid the pound altogether, or if you're going to size in, do so with half the position size that you normally would, or even a quarter of the position size that you normally would, in order to avoid being on the wrong side of a spike like we saw on Friday. Next, we have the dollar yen. And while there isn't much to do here, in fact, I think there's nothing to do here, I have gotten a lot of requests for it, so I thought I'd include it in today's forecast. And I just wanted to point out how incredibly choppy this pair has been. So ever since maybe this time back in here, the pair has been just moving sideways and churning back and forth. So unless you're really quick to pull the trigger and sell these spikes or buy these dips, there really isn't a whole lot to do here. And furthermore, the pair isn't respecting key levels the way I'd like to see. So that's why it may look like my chart is pretty bare up here. And that's because the key horizontal levels I had, this pair is not respecting them right now. So really, until we start to see some kind of momentum from the dollar yen, I don't like trading this pair, and I think there are better opportunities elsewhere. Furthermore, we also have this pair coming into a key level here based on these highs back here. So if we draw a trend line, you can see how the pair is starting to come into this trend line resistance right up here above 109. So that's going to be key for buyers to break. We need to see a close above that area in order to send the dollar yen higher. If we start to see bearish price action form here, or the pair start to rotate lower and take out some of these recent lows, I think that could signal another turn lower, just like we saw back here. So one way to approach this and really play off of this key trend line resistance is to watch for lower highs and lower lows. So yes, the pair is not respecting key levels the way I'd like to see. However, notice what's happened since back here. We've had these higher lows and we've also had these higher highs. Now, this has not changed for quite some time. So what's going to be key is to see the dollar yen continue to form these higher lows and higher highs. Now, if we start to see the opposite occur and we start to see a lower high, right? So it starts to form like this, and then we get a move below these lows and we start to form these lower highs and lower lows, that could be an indication of a turn lower. So if we start to see weakness in that form, that could be an indication of a move lower. But again, I think without a key level here, a key horizontal level at least, it's going to be hard to play this one unless we do see some type of bearish price action up here along this trend line in the form of either a pin bar or it could be a bearish engulfing candle. So if we do see that, that could be a great selling opportunity. Alternatively, if we see a close above this area, that could signal a break higher for the dollar yen. But right now, I do favor staying on the sideline until we see a clear opportunity develop. The Australian dollar finally broke higher against the USD last week, and this is a descending channel that we've been talking about now for months. So notice how this descending channel dates back to 2018, and it's well defined in that we have several highs along the top, and the support area has also supported the Australian dollar for quite some time. Yes, we had intraday spikes below this area, but notice how the pair never did close below it. So I talked about how the pair could be in the process of breaking higher back when we were trading through this area. So this spike higher right through here caught my attention, and I told members that if we start to see pressure on this resistance level, that we could see a break higher. So notice this candle right here did close above it, and we saw the pair retest it on the very next candle. However, something happened on Friday that does cast a shadow over the bullish scenario. This bearish engulfing candle right here does signal weakness. Furthermore, that candle occurred right at 69.30, which was our first target following that breakout last week. Furthermore, we have a trend line that dates back to this low and connects with these two highs that could become a factor on the way up. So even if we see the pair start to push higher, retest 69.30 and close above that, we still have this trend line that could become a factor over the coming weeks. So this week, it's going to come down to whether or not this bearish engulfing candle attracts sellers and eventually closes the pair back inside this channel. So as long as we're trading above this former channel top though, I do have to at least respect the potential for a move higher. If we see a close back inside this channel, that would signal weakness and we could see the Australian dollar sell off. However, again, as long as we're above this channel top, I do think I have to respect the potential for a move back into 69.30 with a break there exposing this trend line up here around 69.80. Last but not least, we have gold or XAUUSD. So I mentioned this one a couple weeks ago, and namely we were looking at this falling wedge that has occurred since the market closed above 1450 back here. So notice this massive uptrend that we saw, and this price action right here does signal, in my opinion, consolidation. So this falling wedge could be a continuation pattern of this recent push higher. So the last time I talked about gold, the market was trading in this area back through here. And what I said is that as long as these higher lows are forming off of this support area, I do think that we could see another retest of this wedge top. And notice Thursday's high came off of that level to the pip. So this pattern right here, I do think that traders need to respect the potential for a push higher if we see a close above this wedge top. If that happens, I do think we could see gold move up into some of these recent highs and perhaps even retest that 2019 high up around 1550. At the same time, as long as gold is below wedge resistance, this level right through here, so as long as it's below that area on a daily closing basis, gold could stay under pressure and even retest that 1450 area once more. But again, I think that given this uptrend and this consolidation that we've seen, this could be a continuation pattern with a close above this area, reigniting the uptrend and taking gold up into that 1550 resistance area. If you enjoyed this video, give it a thumbs up, leave your comment below, and be sure to subscribe to my channel. See you next time.